It's beginning to look a lot like 2018, ladies and gentlemen. Yes, it is. You're watching the Stock Market Brief Show. My name is Michael Silva. You know what made me start thinking about 2018? And I pulled up a chart. Well, Elon Musk just announced Trump, the ultimate stock market pumper, back on Twitter again. Holy moly, and those follower count thing is flying off the chains. It was a close race in the poll, I'll tell you that. Now, the SPY on the daily chart looking back at 2018, we're not going to just talk about the charts. We're going to get into the macro portion of it too, which I find just very interesting. So 2018, what happened? Well, this is known as the Christmas Eve massacre, this big drop off into Christmas Eve, and pretty much the entire month, it was just blood red right there in the S&P 500. However, right prior to that, going into the Thanksgiving, going into December, we actually saw a pretty nice rally, and then all of a sudden December took place. Now, if that's the case here, we're looking at the SPY, we're kind of flagging right here. It's like, oh yeah, that's pretty cool, and then we bust out, and then up December around the corner. Will we get a repeat? Well, it's hard to say, but I do want to just point out the similarities here, just so you don't have FOMO if the market starts to run, right? Like, you can be prepared and be tactical, but there's still large risks here in the system, okay? Let's take a look here. This was from 2018. The Federal Reserve and interest rate hikes. What do you know? They were raising interest rates then. And even back then, they reported that, yes, the Federal Reserve and the world's other major central banks have also been tightening monetary policy. Now, we've been talking about this, right? Tightening monetary policies do what? Reduces liquidity in the markets. Okay, now let's just look at the charts. 2018, what did it look like from the Fed balance sheet? Oh, woo, it was heading down. Okay, well, what's it doing right now? Oh, woohoo, it's heading down. Now, albeit, this was from 4.5 trillion, okay? And now we're looking at around 8.96 trillion, and we're heading down from a much higher level. And we saw over here in 2018 what this kind of stuff can do to the markets. Yes, indeed. Now, another thing that I want to point out here is just you can see it rolling into 2018, right? 2019, it's kind of steadily sloping down. Here we're actually kind of getting pretty aggressive as far as the tightening goes here. Now, okay, let's add another element. Yes, the federal funds effective rate. They're raising rates. Remember? Okay, well, let's look at 2018, what they were doing during this time. Oh, they were raising them. Yeah, that's right, into 2019. Now, where were they raising them from? This is where it gets crazy. From about 1%, or just above 1 point, just we're going to call it 1.2, and they got them to around 2.4, right, just above it, okay? That was the year in 2018 going into 2019. Well, where are we doing right now? Well, we already know they're making record, just massive moves in the federal funds effective rate. We're moving from basically zero, people, and we're already above 3%, okay? And the terminal rate is somewhere around 5 apparently right now. And if you remember on, I don't have the chart, but the Fed Watch tool, they're already saying that we're going to have another 50 basis point rate hike in December of this year. Yes. Okay, so let's take a look here at 2018 versus right now. Well, 2018 was right here, and we started moving up pretty aggressively, right? But that was like 2016. We had some stock market turbulence all throughout here, and they kept on raising rates. Well, look at 2022. Shaboom, right up to the upside. So this is why I'm bringing this up. If we saw this in 2018, what makes you think that we can't see something very similar take place here in 2022 when we're tightening more and we're raising rates significantly more? Interesting. Yes, this also on the back of Powell talking and quoting Paul Volcker saying that they're going to keep at it. This is from the Wall Street Journal, right? We talked about that many times. Once again, if you haven't subscribed to the channel, subscribe to the channel so you can keep up. Okay? Now, another element is these yield curves. Oh, this is interesting. We're talking a deeply inverted yield curve, people. Minus 0.69. What? That is deeply inverted. This is the best indicator for a recession to come. And we're getting a very deep inversion. Now, another one, the 10-year in 3 month. Another great indicator, right? Inverted at 52 basis points. Okay, 69 basis points and 52 basis points. Massive inversions. Now, what were they doing in 2018 to 2019? Oh, they weren't getting inverted, but they were on their way to inversion later into 2019. They were, or you can see from a level up here, and they were, bam, heading down, as you can see right there. How serious is this inversion? Well, people, take a look, okay? 69 basis points inverted. Okay, this is more, this is right here is the great financial crisis. That's how deeply inverted we got then. This was the dot-com bust. We are deeply inverted. We haven't seen these type of inversions since the 80s. It's incredible. Okay, absolutely crazy. And then what was taking place in 2018 with mortgage rates? Well, mortgage rates were actually heading up, and I know this because I started buying right over here. My rate was 4.75. I basically upticked it, but guess what? I refied down here, so it's all good. But now look at the rate at which the mortgage, the 30-year mortgage, is moving right now. So yeah, I'm just adding all these elements together. I'm like, holy moly, people, you got to step back and be very careful here, okay? Let's take a look at another couple of things. The Fed is fighting inflation, so they're between a rock and a very hard place. Yeah, in 2018, inflation was going up, and it was above the target rate of 2%. But look at where it's at now. Yeah, we might have found peak inflation up here, but we're still at a very, very high reading. So they're going to hold rates at a higher point longer, apparently, right? That's what's being said. And they're going to continue to raise them to try to fight inflation. So we will see if what the terminal rate is, or when they back off, or if they pivot. But as we all know, when the Fed pivots, if you look back through history, it's not that good of a thing for the stock market. Let's look at another thing. United States ISM Purchasing Managers, the PMI. We're just going to call it the PMI. In 2018, this was heading on down below 50, right? Going into contraction. Now, where are we? Well, we're right there at the 50 marker, and we're going all the way down, okay? So this looks like very similar to what we saw in 2018, especially, going is 2018, 2019 is probably right here, right? So we were up here, but heading down, and then it went down further into inversion. We're not inverted quite yet. So still in a very same trajectory as we've seen in the past. Okay, now this holiday weekend coming up, we have Thanksgiving, so the stock market is going to be closed. And then on Friday, so Thursday it's closed, and then on Friday, we're going to have an early closing session. So understand that next week, coming into this market, we're going to see a shortened trading week, okay, which is important to note because we're going to go over the implied volatility here right now. If we take a look at the S&P 500, currently it is, this little tiny flag here. We talked about a potential for a bull trap. And to be quite honest, I think we tagged it on the head, right? It opened up, the SPY was right at around 398, which was one of the markers we talked on the prior video. And then it started selling off, and then it came back towards the end of the trading day. It was OPEX. Option expiration brings on more volatility. So can we see more of an uptick? Absolutely possibility. Where can it potentially go into next week? It can go to around this. Actually, I'm just going to pull it up right here. Go ahead and screenshot this so you can have it for yourself. These are the expected moves for the S&P 500, SPX, the SPY, Qs, IWM, and the Diamonds, Dow Jones. Okay, right here is going to be the upper weekly expected move to watch, the lower expected move. This is the expected move to watch. So going into a shortened trading week, the S&P 500, the SPX, is looking at a plus or minus $72 move. So the upper edge is 40.37. That is right here, 40.37. So if the S&P 500 wants to come tag that, be aware that that's also in confluence with what? The downsloping trend line, yes, and the 200-day moving average. Yes, and we are above, an inclining 20-day, so it's doing all right, but we can't just let our guard down. Do not do it. If you let your guard down in a market like this, you can be blindsided, okay? Not to say that we're going to get some sort of repeat, okay? But you can't rule that out. So have stops in place, right? If you believe right here, it looks like a bull flag to me, right? But actually, we'll just go right into the 15-minute time frame. It looks like a bull flag to me. Okay, we're trading right around the 5-day moving average. You have a nice pull, boom, bam, it brings up, maybe it does tag this, maybe it goes above it, okay? But you can't let your foot off the gas. That could be that holiday rally that we see very similar in Thanksgiving, but then we might have some sort of, dramatic thing happen towards the end of the year. It's possibility, doesn't mean it's for sure gonna happen, people, but we need to just look at everything like that. Now, if you like these type of weekly expected moves and you haven't done so already, check out my Patreon group, $9 a month, or just pay annually. Yes, it's very cheap, but yes, I add a lot of value, and I'm continuing to add value. I'm actually bringing on the zones, which I don't have right here in the benefits, so that is what it is. I got to update it. Weekly expected moves are these expected moves, but I do like a list of like 30 or 40 of them or something like that. The zones are getting more intense, in my opinion. I'm giving a lot of data right there. It takes me a lot of time to compile that Excel document. I get get some trade ideas. I update my watch list. Right now, it's been a pretty rough market. So I recently did it about a couple of weeks ago. When the market's in a bull market, I'm updating this thing like weekly. And then yes, you have access to an amazing community of people. We have a monkey trade in there. We have all kinds of crazy things going on. If we go and continue on, I want to call out the dollar. The dollar has been breaking down. That has been making this S&P 500 flag. What I find interesting is, look at this. This is moving up and flagging. This moved down and this is flagging. So guess what? If this breaks down, this probably breaks up. If this starts bouncing, this probably breaks back down. So it's something to continue to watch there, right? The dollar has been holding strong. I would say just keep an eye on this 104, 105 level, right? We had previous areas of resistance, right? So resistance, boom, boom, can turn into support. And now we're right there around that support level again. So this could be a very well area where we can start to see a bounce and then see other assets actually take a back seat a little bit. So something to pay attention to. BPSPX chart's not overextended anymore, and this negative divergence is starting to play out. So what would be interesting is if we saw a bounce, it comes right back up into overextended territory and it's still holding a negative divergence. So be aware if that's the case. Yeah, be cautious, right? Be very cautious, because if we're looking at 2018 as a potential like thesis, potential play, well, if we do get that Thanksgiving rally, that would actually do exactly just that, right? It would bring the BP-SPX chart back into overextended territory. So when we come back into December, it's on a negative divergence and it can start heading back down again. Maybe not to the same extent, but who knows? If we take a look at a weekly chart, we have a high wave or a spinning top, whatever the hell you want to call it. Doesn't matter to me. It looks very similar to these type of bear market rallies, and they slow down, right? You have a big authoritative candle, then you have a small little tiny body, and that's followed through to the downside. You have authoritative candles, and then all of a sudden you have a small little body, and then boom to the downside, and then bam to the upside, big authoritative candles, and then you get a small little body, and then is it going to be bam to the downside and follow this trend down or not? It's very hard to determine, but this is not exactly the area where I want to start loading the boat long into a declining 200-day moving average, into a pretty large prior week, right? I would like to see more consolidation, or I'd like to see a pullback and then move and create another, higher low. And if that's the case, we might be looking at this as like, oh my goodness, it might be just a big old, inverse head and shoulder pattern. And then we run off to the moon and stars, right? The Dow Jones Industrial Average, also you can see momentum is slowing here on this prior week. It was flat on the week. It was slightly down. The S&P 500 was down less than 1%. So we had a lot of movement, but we didn't go anywhere, okay? The Dow Jones, has been the best performer. It's not honestly too far off from its 2022 high, which is, would basically bring to an all-time high if it were to be able to get there, right? But, it's been on a very run. We haven't seen any consolidation. And the other times that has happened, boom to the downside. Boom to the downside. Okay, so be on guard, right? Be on guard. The Nasdaq on the weekly time frame. I like this little bullish crossover here. You had a little bit of a positive divergence on the MACD, right? Lower low right here. Then we had the higher low. Blah yada yada. We started moving up, but this one, this index finished down 1.18%. So the big tech, it's getting hit, and this is not the greatest looking candle. So what you want to do is say, hey, if we start crossing down 11,500, it might open the door for some more downside. But if we start getting above that 12,000, it might open the door for some more upside. So, it's going to be an interesting week to say the least. And it's going to be an interesting fourth quarter, to say the least. Now, if we take a look at the IWM, this one finished down to as well 1.7% on the week. A lot of movement, ended up finishing slightly down. Okay, we're right there at that 200-day moving average, which is roughly the 40-week moving average. Okay, and this has been on a monster move from where? From a prior low, right? So it bounced from here, boom, it came right back into support, boom, it bounced again. The more times that this is tested, the worse, right? You have a high, a lower high, a lower high, a potential lower high, and then eventually this thing gets cracked and you get some sort of flush. I posted on Twitter actually an interesting chart of a 5-year span of the IWM. I suggest to go look at it because this right here is a very important level, and it flushes. There's a volume shelf profile a little bit further down to be on guard for. Not to say it's going to happen, but it's something to watch out for. Now, another thing to look at is, hey, people are going to call this a double bottom, but the double bottom wouldn't be actually until we see actually a severe break of 200, and then that opens the door for some further upside. That's all I got for you on today's video, everybody. Hope I showed the risks involved in this current market. Be on guard, be tactical. You can buy these dips, you can slowly dollar cost average, there's all these strategies that you can do, but what you don't want to do is just get a lot of FOMO and push all in and they get blindsided. So be careful out there. As per usual, that is the theme of this pretty much channel. See you later.